Coming up on Market to Market, the Senate rewards both traditional and renewable sources in newly passed energy policy. Automation comes to the farm in new ways, aiming for efficiency. And paying tribute to a familiar voice in agriculture with the next generation. Those stories and market analysis with Dan Hueber next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, April 22 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. If home is where the heart is, then the housing market is beating stronger. The National Association of Realtors said this week the sales of existing homes increased 5.1% in March after a slumping February report. New home starts dropped 8.8% according to the Commerce Department. And it was back to the 70s this week as weekly applications for jobless benefits for the second consecutive week recorded levels not seen since 1973. However, the Rural Main Street Index once more is below growth neutral. The Creighton University survey of rural bankers revealed a rate of 38.2, the 8th straight month under 50. Now, energy is also a driver of the economy in the area surveyed. Industry leaders of both fossil and renewable sources were watching Washington this week as one chamber took up a bill aimed at helping both special interests. But it was on Earth Day that nearly every country pledged to change the world.
Secretary of State of the United States of America.
U.S. Secretary of State John Kerry joined 170 other countries in signing a landmark climate change pact Friday at the United Nations. Never have so many countries signed an agreement on the first day than the Paris Agreement. Countries that penned their support must now ratify the plan to counter hotter temperatures, rising seas, and other impacts of climate change. Many major oil-producing countries have yet to move forward with the plan. Coincidentally, this week, differences among members of the U.S. Senate gave way to major improvements in how America handles renewable and fossil fuels. In a strong sign of bipartisan agreement, renewable fuels, minerals mined for electronics, and clean coal initiatives were all winners with the 85-12 passage of the Senate's Energy Policy Modernization Act. The new energy measure is made up of elements pieced together from energy bills passed by Congress between 2005 and 2007. Technological breakthroughs ushered in new additions to the bill, including advances in electrical grid construction techniques and improved building materials that make homes more energy efficient. Fossil fuel interests will benefit from the new energy bill. An approval process for exporting liquid natural gas to foreign markets was streamlined, and projects to capture carbon dioxide from coal-fired power plants, as well as other clean coal initiatives, moved forward. Environmental issues also were addressed. Funds established for conservation and protection of the environment set to expire this fall would be permanently reauthorized. The new act also includes provisions to encourage land conservation. The bipartisan legislation puts renewables in a favorable position, giving solar, wind, and other green energy sources a boost. But the Green Energy Advocacy Group 25 by 25 doesn't think the boost is strong enough, saying, "The bill is not as comprehensive as some of our members would have liked. On balance, it is very helpful and an important step forward." The Senate bill now heads to a conference committee, where differences with the House energy bill that passed last December will get sorted out. The two pieces of legislation oppose each other on several fronts. President Obama has already said he will veto the House version if it lands on his desk.
President Obama's immigration policy was on trial this week in the Supreme Court. Justices heard arguments in a challenge brought by Texas and 25 other states over two programs that could shield roughly 4 million people from deportation and make them eligible to work in the United States. Many immigrants begin their U.S. work history on farms. And without a regular supply of labor, some operations are forced to fallow land or even let crops rot in the field. Peter Tubbs reports on new innovations down under that could help solve a labor shortage.
An Australian company hopes to push robotic farming technology forward by building field robots that are simpler than their predecessors. The group of robots will work together to complete tasks.
These are swarms of little lightweight robots that work cooperatively to work out in the field.
Swarm Farm founding director Andrew Bate reports agricultural robots had been trending towards more complexity, making them expensive and difficult to operate.
They'd become that heavy and that complicated. I started to sort of realise, well, we're going backwards. Every new model that came out was bigger than the last.
By designing a pack of simple, inexpensive robots intended to work together, productivity goes up as operational costs go down. While the robots perform simple tasks like spraying weeds, farmers are free to complete higher value work.
Especially with the skills shortage that's coming through, you can, instead of employing someone briefly, you can, in the busy times, you can just use these robots.
Reducing the need for human labor has driven the development of robotic milkers for dairy operations. This project, on the Australian island state of Tasmania, has converted a grass-fed dairy herd to all robotic milking. As an early adopter, the transition has been difficult.
I think I was about the 8th or 9th farm in Australia and probably only the 3rd or 4th pasture-based one in Australia, which probably made it the 10th or something in the world to be pasture-based system, so there was no information at all about that.
That small body of knowledge has slowed the adoption of automated milking in Australia. This farm is now acting as a model for others.
So we thought that having a focused farm where farmers can come a couple of times as a field day will be very beneficial.
The dairy's higher electricity costs have been offset by reduced costs for labor, allowing the operation to slowly expand. On the other side of the globe, 2 American engineers are changing traditional thinking and have built a facility to produce hydrogen and ammonia to replace diesel fuel on an Iowa farm. Inventor Jay Smucker has leveraged 50 years as an engineer at NASA's Jet Propulsion Laboratory on the attempt to find a green fuel to use on the farm.
It started off a memorial to my dad, and then I just wanted to do something that hadn't been done before.
The first iteration of the project collected hydrogen through electrolysis, which breaks apart the hydrogen and oxygen atoms present in water. The hydrogen is collected for fuel, and the oxygen is released. The system currently generates roughly 10% of the fuel the farm would need to operate solely on hydrogen year-round. The project later moved on to producing ammonia, which is more difficult technically, but allows the storage of more energy in the same space.
The tractor runs, the engine runs on hydrogen by itself, or it runs on basically 20% hydrogen and 80% ammonia. When we're running a combination fuel, we actually have about 30% more power than just running hydrogen.
While the entire system was built with off-the-shelf parts, it is far from cost-effective at this scale. But the concept has now been proven. The system is well suited to a farm environment, as it generates fuel year-round, while the farm needs fuel in short, intense bursts around planting and harvest. A larger scaled system could take advantage of off-peak renewable energy to produce fuel at very low cost, helping to defray the large startup capital expense. Whether using hydrogen or ammonia, the tractor's exhaust is pure water, nothing else.
There is no carbon footprint. It's totally green. This is a world-changing project. How much better can it be than this?
For Market to Market, I'm Peter Tubbs.
Next, the Market to Market Report.
For more than 2 decades, my father, Mark, sat in this chair delivering the market reports. And this week, his spirit lives on, tying academics and the love of agriculture together.
In June of 2012, longtime Market to Market host Mark Pearson passed away unexpectedly. Mark spent the better part of 2 decades as the program's anchor and was always on a mission to educate America on the importance of agriculture.
Hello, I'm Mark Pearson.
Almost 4 years ago, to honor his legacy and tireless commitment to agriculture, Rob Denson, president of the Iowa-based Des Moines Area Community College, began work on creating a scholarship program for Hawkeye State FFA chapter presidents. His work culminated with the creation of the Mark Pearson FFA Leadership Scholarship.
So it's now a time to reward them in a way that's meaningful. I mean, they will leave DMAC no matter where they go. They have lower student debt, very, very small class sizes. So they will learn with the best faculty in the world and be ready to help Iowa move forward into the future.
This week, Iowa Governor Terry Branstad held a press conference to introduce the first 2 scholarship recipients.
Mark would have loved this scholarship initiative because it will help build on the next generation of agriculture, community, and business leaders.
This one-of-a-kind scholarship offers Iowa's 226 FFA chapter presidents a chance at 2 years of free tuition. The recipients can choose any of DMAC's areas of study. Funding was provided by a wide range of donors, from business leaders to agricultural groups. Cassidy Kuhlman of Reedland, Iowa, is following a path that leads to teaching agricultural education.
To hear about the scholarship, I'm just completely blown away and, again, completely surprised. It's an amazing opportunity, and I'm just extremely grateful for it.
Among the dignitaries in attendance was Pearson's wife, Eden.
For Mark's name to be attached to something like this, that's actually giving back to individual people. That's what he liked. He liked the connection with people. Individual people that you can track and say, I was helped.
For Market to Market, I'm David Miller.
One of music legend Prince's most famous songs starts with an apology about causing one sorrow and pain. His words rang true with commodities this week. Instability in the South American crop provided a shot of adrenaline to the market, but then nearly fell off the table on Friday. For the week, the May wheat contract gained 7 cents, while the nearby corn contract lost 7 cents. A drier Argentina and forecasted rains in Brazil dampened the big rally in the soy complex, where the May contract lost 30 cents on Friday and still settled 31 cents higher for the week. May meal put on another double-digit rally, rising $15.80 per ton. In the softs, the May cotton contract jumped $3.05 per hundredweight. Over in the dairy parlor, May Class 3 milk futures shed 32 cents. And it was a rough week in the livestock sector, where the June cattle contract plunged $7.52. May feeders weakened $8.10, and the April lean hog contract expanded $1.30. In the currency markets, the U.S. dollar index jumped 41 points. The May crude oil contract advanced $2.02 per barrel. June COMEX gold declined $4.60 per ounce, and the Goldman Sachs commodity index rose 11 points to settle at $347.90. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much. Great to be here.
Great to have you here. An exciting week.
Very nice week to kind of come back on, although didn't quite hold in for the weekend, but it was nice to see the activity and the excitement once again. A little volatility pickup,
yes,
which always brings a little more opportunity.
Nice to see some outside the range trading. I mean, at least it does bring some excitement back to commodities.
Exactly. Yeah, and this is built for some time, so it's nice to kind of see these things come to fruition. And maybe we're a little bit premature at this point, but still, it's like I say, offers some opportunities we haven't witnessed for months.
You bet. So now, speaking of opportunities, we saw wheat end the week higher, ended 7 cents and change higher on the nearby. Is there rally left in this wheat market?
I guess I tend to, and of course I think we want to look at commodities as a whole right now. Probably all of them have stretched it maybe a little bit further than we realistically should have. For the time being, though, I think we took a lot of shorts out of the marketplace, corrected the oversold situation that was prevalent here a few weeks, even just a week and a half ago in the wheat market. But I don't think there's much ammunition left to really kind of buoy us back up unless we see something new develop. And granted, there has been some concern about some of the cool temperatures, the exposure in the wheat crop. But here again, I don't think it's been enough to necessarily change that overall fundamental picture that much.
We're still just sitting on a lot of wheat.
Exactly.
Okay. Yeah. Marketing advice for wheat producers. I know we're still a little ways out from harvest, but as we get into it, what should you be doing here?
And of course, wheat is a tough one, particularly in our area because of the variability, such variability in yield. So, individuals we spoke with this week, we said certainly reward the rally with what you're comfortable on. You think you're going to have for production. That said, I don't think we're necessarily done for the year, but we could have a 30 to 45 days of a little more sedate markets, and then hopefully some activity to the upside after that.
Okay.
So.
On the corn market,
yes,
we did actually end the week down. We had a fun beginning of the week. We saw December corn trade up over $4.
Absolutely.
We broke. Is this a break that's going to continue into next week?
I suspect so. In fact, I wouldn't be surprised to see us continue right down into at least early May, and probably without a new stimulus in there, probably stagnate a little bit into even the month of June, when we can start refocusing on summer weather. Interestingly enough, I don't think with the shift we saw, we took a lot of a bearish attitude that had been, just pressuring this market, of course, for months and months. Have kind of set that aside with people finally recognizing that all of our risk is yet in front of us. I mean, we have no concept of what our summer weather is going to be. Still a lot of talk about what could happen if we truly go to a La Nina. So I don't think we're going to have those bears necessarily coming back in force like they did before, at least until we get out into latter June, maybe July, and that's, of course, assuming that everything is clipping along with nice conditions at that point. So I don't think we're back to as low as we were previously, but on the same token, there's just not a lot of really big stimuluses here right now to take us back higher either.
Okay, so. Now I did see a lot of trucks moving, a lot of trucks hauling grain Thursday and Friday of this week.
Sure.
Is it too late to get some sales on the books? Let's talk old crop corn first.
It's, and again, we're still elevated from levels we were, let's say, of course, in January, February. And I guess we have so many tools available. I guess we never necessarily discourage somebody from making sales. There's not a lot of carry in the corn market. So if you're in an area where the basis is tightened back up with a break, why not take advantage of it? We certainly had recommended people to sell the rally this week, really with the idea, though, yes, this is probably not for the year. You always want to reward a spring rally if you have that opportunity, but with the idea, we believe, on if we do get a break back down in May, June, probably come back with some call options at that point to kind of protect those positions and see if we can't get a little more firework as we move out into
Sure,
the
look to put
months.
some ownership back on your side of the ledger.
Exactly.
All right.
It's a lot easier to carry paper sometimes than it is physical. So.
You bet. Now, soybeans. Let's talk old crop soybeans first. This has been an incredible couple of weeks.
Absolutely.
Watching that market invert, and then it's just been crazy. Old crop beans, is there still upside in this old crop market?
Once again, I think we probably tend to have overshot the mark this week. A lot of the stimulus, in addition to, the weak dollar this year and the funds coming out of it, and really a lot of investment money moving back into commodities finally, really I think probably took us to levels that were a little more exaggerated than they should have been. Of course, the big story of the week that kind of drove in the highs was the rains, the problems they're having with crop conditions in Argentina most specifically. And most of the people that we listen to in the weather scene say, okay, there is some damage down there, probably a little bit overinflated as far as what we did in the marketplace. Not to mention, if we could give up a couple million or 2-3 million metric tons, doesn't really change that world fundamental picture all that much. So it's like I say, it was a great rally that came. A lot of it was just more of the function and the mechanics of the market when you correct things. But we really are not backing up that with a true underlying shift in the fundamentals. So pretty tough to sustain those kind of moves for a long term. So.
Okay, new crop beans, watching, especially when we were over $10, how aggressive are you at putting on some sales up in that level?
We actually took people up to 50% sold this week.
Okay.
We started at the 950 area and then basically said, any 25 to 50 cent rally, you just have to kind of keep building on that. Here again too, I think it's early enough in the year. There'll be some additional opportunities later on. We'll probably come back and reposition with calls as it comes along later in the summer if we get that opportunity, or early in the summer if we get the opportunity. But that said, boy, $10 beans, the economics are there. You really need to take advantage of those kind of rallies when they present themselves.
Okay, now we do have a question from one of our followers on Twitter.
Yes.
This is from Fran, @FranTheMan44.
Okay.
He's wondering, does this recent run-up in soybeans mean that beans are buying some acres away from corn?
I would tend to say even before the run-up happened, we were probably tending to see some acres shift back over to soybeans. So it's, and again, if it was 1 million acres total, that would be a huge shift. I don't know if it's going to be that. But I do think that corn acreage number that the USDA kind of shocked everybody with at the end of March was maybe a bit overstated to begin with. And I think instantly people started thinking, maybe it's time, the dollars and cents, they weren't huge in the soybeans. A dollar rally helped make that a little better, but economically it was making more sense to why take that risk on the corn, with particularly if that acreage number was correct. And I think we were already seeing people tend to shift over in that direction to begin with.
So now that 93.4, 93.6 million acres that USDA put out, what's closer to an acreage number you're going to utilize this year?
I guess we're probably more in the 92 to 92.5 range.
Okay.
So it's maybe a million and a half acres overshot. So it's and again, that's assuming things continue fairly normal. I mean, granted, we're off to a pretty good start, although when you look at the numbers on the planting so far, it's heavily weighted towards Missouri and Kansas. So it's not that we've got the I states that have really made a lot of progress yet. So, but we all know, 7 days we can have a lot of corn planted.
You bet.
So
just need some dry weather and machinery to not break down.
A little warmer temperatures. Yeah,
you
exactly.
bet. Now, I did want to get your thoughts on the cotton market. We had a $3 move to the upside. Was that just spillover support, that broad-based commodity market move?
I tend to think so. Now, granted, you go back to the USDA numbers, there was really nothing negative within those numbers. We're seeing cotton acreage continue to be lost, but I do think it was, I think in many of these markets, they're almost like a pressure cooker. We kept the lid on for so long there. Once it popped through, you just really eliminated a lot of shorts, which just kind of built that pressure up, declining open interest, which would say, we're just taking people back out of the market. So again, a great rally to see. I think we made some very nice retracements of the entire move down from last year, but by the end of the week here, it looked like we've kind of lost the steam. The momentum was behind us, and you might have exhausted that move for the time being.
Probably a pretty good opportunity in the cotton market to get some sales on
once again to go ahead and take advantage of the bounce.
Okay. So, yeah. Now livestock. Moving into live cattle, off $7. We had the cattle on feed report come out. Are those numbers enough to really move this market?
And again, of course, especially this week, you had the cattle market push down June cattle and with the new contract lows. And, it's not that the numbers that I've seen out there are really all that bad. I think the weights have been coming down a little by little. Feedlots do look like they're pretty current. I think the weekly kill is still maybe just a smidge above a year ago, but it's not like we're backing up a lot of beef, which we tend to do often on these kind of slides. Now, from what I can gather on those cattle and feed numbers, I think we were, particularly on the placements, we were a little behind what the trade was looking for. So maybe the combination of this flush out to the downside this week and fewer numbers, or at least fewer than expected out there, could be enough to stabilize us and ideally start moving us back to the positive side.
Longer term, as we look out at this cattle market, where do you think we fit in the cycle? Are we where in the downturn of this cycle do you feel we are?
I guess I would, and I'm going to kind of group hogs and cattle both together here. I really would like to think at this point in time, we have, again, a little bit shocked we saw cattle move to new lows this week, but I think we're in a rebuilding phase as far as the numbers out there, but on the same token, we're also looking at, respectable demand domestically as well, and now back over to pork, you're seeing actually some great interest from China on pork. So it's, I think in that category could lift us both out of here. And here again, too, there's something, we often think about the dollar and the grain market, but it would have just as major of an impact if we saw that dollar continue to break on the livestock trade. So.
Do you expect this dollar to continue to break? We had a little bit of strength this week on top of last week's strength.
Right.
Are we going to correct back to the downside?
It is oversold enough that you can make a case that we have a bit of a correction back to the upside here right now, but that said, there's just really not a lot, I don't think, that's going to carry us up. I think the dollar has continued to have been a little bit overinflated to begin with, just because of some of the monetary policies that have been going around the world at this point in time. I don't think it's necessarily, yes, our economy is better than many others in the world, but we've already factored that in. So it's, I still think later in the year here we can see the dollar take a little tip to the lower side, which I think would psychologically, at a minimum, be a nice boost for the commodity sector.
You bet. Now, we talked live cattle. I wanted to get your thoughts on feeder cattle. This has been a pretty steep correction here in feeders. Is there still room to the downside?
Well, and keep in respect there as well that this grain market rally, particularly the corn rally, has been working against that feeder cattle market. So if we technically believe that the corn market has maybe seen its rally to the upside here right now, I think psychologically that's going to help out that feeder market quite a bit as as well.
Okay, maybe as corn tops, we could see feeders
pick up a little
bottom
strength
at least
again.
temporarily.
Correct. Yep.
Now, follow up on the pork market. Talk about how we kind of see this market, cattle, pork. It's the meat market, but we see pork continue to strengthen, up $1.30 on the week in the nearby. Could you really attribute that to China's demand specifically on the pork side?
Oh, I think that it's been a major contributing factor to stabilize us and the strength. Now, granted, we really have not come that far off the lows just yet, but I think here within the next week, 10 days, it looks like indicators are starting to shift back to the positive, so I think we have room. And that's really not a bad seasonal either. You tend to get the hogs down into April, May, and then we see a summer rally once again, or back up into June, July. So it's nothing terribly out of the ordinary. Not unlike a spring rally in grains. You tend to break them down into early summer, and then of course you always have your 4th of July. I shouldn't say always have 4th of July excitement, but often do. So it's many of these are just kind of seasonal patterns right now. So.
Okay, so given the seasonal patterns, what's the upside potential in this hog market, for example?
Well,
a couple dollars, $10, $15.
I would at least like to think $4 to $5 back to the plus side.
Push up towards 80 in the nearby and see the deferreds run up a little bit higher.
Where the resistance was really a month or a month and a half ago.
Okay, that'd be the new top side.
Right.
Now, crude oil market. Crude's been all over the board. So many factors impact that. Where's it going this next week?
It didn't, and I didn't catch the actual close today. I know we were back above $40 once again. You've had a couple of really opposing factors out there. I mean, coming in Monday, the trade was a bit disappointed because they didn't really come to an agreement on who's going to cap production.
Right.
Iran really wants to get back and recapture some of the market share they lost through the embargoes over the years. But regardless, there was just enough disruption in Venezuela with some production. You had a strike going in Kuwait. In both of those cases, that's a little bit behind us, but the market still responded positively. So I think this
positive side.
$43 to $45 range is probably not a bad area in the crude.
All right.
So.
Dan Hueber, thanks so much for joining us this week.
My pleasure. Thank you.
That wraps up the broadcast portion of Market to Market, but Dan and I will keep the market discussion going and answer more of your questions during Market Plus, available on our website. And do you have thoughts and suggestions about the program? Then send an old-fashioned email to markettomarket@iptv.org. And join us again next week when we'll look at a forest in an unlikely place in the heartland. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.